Good morning and welcome, everyone. I am Kyle Neal, Principal and Co-Leader of Mercadien's Nonprofit and Human Services Group. Today's webinar is on the Secure and CARES Acts and how these impact your retirement plans. Today's webinar qualifies for 1.5 CPE credits. 5 polling questions will appear throughout the webinar. At least 3 of the polling questions must be answered for active participation. After today's webinar, an evaluation form will be emailed to all the registered attendees, along with a copy of the slides and a link to the recording of the presentation. Please complete and return the evaluation form. CPE credits will be sent to those that complete an evaluation form and have answered at least 3 of the 5 questions. Today's webinar will be presented by our special guests. Peter Ponzio, Senior Vice President with Penn Investment Advisors, and Melissa Kurtzman, shareholder and co-chair of the Employee Benefits Practice Group at Littler Mendelsohn. In addition, the webinar will include a panel discussion featuring Roger Chandler, Senior Vice President with TAG Resources, and David Mitchell, Regional Vice President with Transamerica. Participants are encouraged to submit questions through the Q&A function. I want to thank our presenters as well as our participants today for joining us. So without further ado, I now turn it over to Peter and Melissa. Thank you.
Good morning, everyone. This is Pete Ponzio. Appreciate the opportunity of being in front of everybody via a webinar. Obviously, this is unique circumstances for all of us. And first and foremost, I hope all of you are healthy, well, and safe. We're definitely in interesting times. I was asked if I could put a presentation together on these few acts, and I agreed to do this for the organization, but I also had some friends in the industry that I thought would also want to participate and bring some value to the table. So let me reintroduce them. Melissa Kurtzman, who I've known for a long time, part of Littler, from a professional courtesy point of view, she's a go-to person for me when I have some legal or ERISA or benefit questions. And she comes to us from California this morning. Good morning, Melissa. And sorry that you're on the West Coast and not on the East Coast, but appreciate you being online this morning. Also,
yeah, happy to be here.
Thanks, Melissa. Sorry. Also on the call are Roger Chandler from TAG Resources. TAG is a nationally known 316 fiduciary third-party administrator, another individual that I go to and pick his brains from time to time on questions regarding the administration of retirement plans. And welcome, Roger. And finally, David Mitchell from Transamerica, another individual that I've known for many years and use his wealth of knowledge in plan designs and other pieces. So forgetting about the organizations that we all work for or with, we all come with a lot of knowledge and expertise in the retirement plan industry from different angles. And I value each one of these individuals' expertise. So thank you to all of them for helping me along in doing this, because not one individual can know it all, and I don't pretend to overall. Luckily enough, I've been doing this for 36 years, and they say in the world that if you're a lucky person, if you like what you do, I have the privilege of saying I love what I do. I've been doing it for 35 of my 36 years as a financial advisor, and it's a very promising business line that I handle. I help people save money for retirement and plan for it. So it's a great position, and I'm very lucky to say that I love what I do and fortunate that. The first slide this morning is on, the first part of the presentation, we decided to go in reverse and talk about what act happened first, which is the CARES Act, standing for Coronavirus Aid, Relief and Economic Stimulus Act. You'll notice that most acts that come out of Congress and the government have some type of acronym to them. So, first question there, are furloughed individuals and others affected by COVID-19 permitted to take distributions? I know Melissa and I have chatted about this quite a lot. And Melissa, I'll let you go ahead and take that first part.
Sure, Pete. And again, thank you for all being here. And I really appreciate attending and speaking at this presentation. And as Pete said, we've been working together a long time. I've been an ERISA attorney for, 34 years. And I do love what I do. And as co-chair of Littler's Employee Benefits Department, and we're nationwide, or actually worldwide, but nationwide, we have been getting a lot of questions from our clients all over the country. And this is one of the questions we're receiving from our clients. But before I get into whether or not they're permitted to take a planned distribution, the first question is, who is a qualified individual that can take a distribution from a profit sharing plan, a money purchase plan, a 403B plan, and a 401k plan? And different record keepers have different speeches that or talking points that they provide to their participants. But a COVID eligible participant is an individual, there's his or her spouse or his or her dependent that is confirmed to be diagnosed with COVID. So it's interesting. It's not just the plan participant, but it's the spouse or designated dependent who can be a qualified individual if they are tested and are positive for COVID. However, the next part of who is a qualified individual is solely for the plan participant, and different record keepers are providing different answers on this. So it's very important that you speak to your record keeper to know what their script is. So for example, a participant who experiences adverse financial consequences of either being quarantined, furloughed, laid off, or has his or her work hours reduced can be a qualified individual to receive a distribution. Or the individual cannot come to work, if the participant cannot come to work due to lack of child care. So it's very important that the qualified individual understands the rules of becoming a qualified individual. The CARES Act permits a plan sponsor to amend its plan to provide furloughed employees and others impacted by COVID-19 to receive plan distributions of up to $100,000. Now, this was signed into law on March 27th, 2020. It's so first of all, it's optional. So you as a plan sponsor may or may not add this to the plan is a in-service type of distribution feature. Many record keepers in the first week of this act basically opted you in or opted you out of this provision. So you may not even know it right now, but you may have opted in due to lack of responding to a plan administrator or a plan record keeper. So after this webinar, I would advise you to just check with your plan record keeper to see if you are opted in or opted out of this provision. Secondly, the plan participant receives a waiver of the 10% excise tax if he or she is under 59 and a half. So that's huge. The participant doesn't have a penalty tax. In addition, the participant is not going to have a 20% withholding tax on this distribution. However, they will be subject to the 10% voluntary tax unless they opt out of the voluntary tax. And specific states have different state taxes. So your record keeper would know which state tax applies. So the participant could actually elect 0% as a tax immediately. What's interesting and novel about this distribution feature is that the participant can repay this distribution as a rollover to a plan or an IRA within the 3-year time period of taking that distribution. So if the distribution is taken, for example, December 31st of this year, and that's as late as it could be taken currently under the current law, you have 3 years to repay it. If it's not repaid, though, however, it is income tax. And generally, the participant can avoid income tax immediately for the 2020 year if they do not pay that on their tax returns. As a plan sponsor, if you're in a record keeper's plan document, like a volume submitter plan or a prototype plan or even a MEP plan, the plan amendments are not due generally until the end of 2022. So there's plenty of time to actually make an amendment to the plan, even though the operation happens in 2020. There are just certain notice requirements, and interestingly enough, the government just recently passed electronic disclosure requirements that help the notices of this. And I'll tell you, I was in a committee meeting the other day, and this is an actual case. The client wanted to add this distribution feature, but the investment advisor said, well, it'll deplete assets, so we really shouldn't tell the participants. If you add this as a feature, you cannot hide it from your plan participants. I had to speak up at that committee meeting, and it was not Pete, by the way. Pete would never do this in a million years. I had to say, ERISA requires truthful disclosures to participants. So you either add it and provide participants the information, or you don't add it at all. What's great about this for a plan sponsor is if you don't have actual knowledge to the contrary, the participant can self-certify this with your vendor. And it takes you out of the equation of whether or not they are a COVID-eligible employee or participant, I should say, and can take the distribution. Unfortunately, I had the experience this past week with a record keeper that had a plan participant of one of my clients call up and ask for a COVID-eligible distribution, like this $100,000 distribution. The script of the record keeper, because this was all done by phone, did not include language asking the participant or telling the participant the rules of a qualified individual. So it didn't tell them that it's the participant that experiences a adverse financial consequence for a quarantine, furlough, or layoff. This participant first came to my client, the plan administrator, and told them it was his spouse that had the adverse financial consequence. That means that the participant is not a COVID-eligible employee. Unfortunately, the client was on actual knowledge that the participant was not a COVID-eligible employee. So they called up the record keeper. The participant then went around the plan sponsor, called the record keeper. The record keeper did not ask or did not explain who a COVID-eligible participant is. The participant self-certified he was. A check was issued, the plan sponsor stopped the check and put it back in the participant's account. We asked for a recorded line of the conversation. We were provided a summary of the recorded line, not the actual recording, which was required to be delivered to my client. So at this time, we're trying to fix the procedures of this national record keeper, frankly, to explain to participants who is or who is not a COVID eligible employee. So it's something you really want to make sure of, that your record keeper is providing the right language for their customer service reps to utilize.
Melissa,
For you as a plan sponsor to rely on self-certification.
Melissa, this is Pete. Thanks for bringing that up, because I always use, and what I'll relate to the people that are online, I use a thought pattern called the babysitter approach. And
Yes.
the babysitter approach that I use is that I'm a parent. When I go to, obviously when my children were younger and that my wife and I would want to go out and we'd hire a babysitter, it was my responsibility to vet that babysitter to make sure they were a responsible individual and take care of my child, right? So if I'm going to leave my child in the custody of some other person, I want to know who I'm leaving them with, and I want to vet that individual. So versus just having, okay, let's hire a babysitter and that's it, right? So I like that babysitter analogy when I use it for retirement plans, that when you hire a retirement plan provider or advisor or whoever, make sure you vet them and you understand who you're hiring, and the morality and the credibility that that individual brings into the table today. So that's important. And the only other piece that I want to bring up is the one about the repayment of distribution over a 3-year period of time. I know there's a lot of gray area around that right now. How does it get repaid? How does it get back into the plan? Who writes the check back into the plan? Does it have to go into the plan? Does it have to go to an IRA rollover account? But that's a whole nother discussion for another day. I just wanted to bring that to the point that there's some gray area about how that distribution that a person can take of this to waive the excise tax, but want to waive the regular taxation of this asset. How does that money actually roll back into the plan? So that's a discussion.
Right, and Pete, I forgot to mention, important piece of this is that if the participant does not repay the distribution as a rollover to an IRA or to the plan sponsor's plan, and the plan sponsor, by the way, that's an optional provision. The plan sponsor could say no to these 3-year rollovers, and then the participant must put it into an IRA. At least that's the guidance we're getting today. That obviously can change within the next few months. And the participant under this rule has 3 years generally to pay the income taxes rather than have the income tax due and payable for the 2020 plan year,
Yep.
like most distributions. So it is a favorable tax treatment for these distributions because the folks obviously impacted by this, have a severe financial impact in their lives.
Moving on, I think we pretty much answered that question thoroughly. The next question is, does the CARES Act provide more flexibility regarding plan loans? My first, and I'm going to, Melissa, if you don't mind, I'm going to chat a little bit about this. My first opinion about plan
Absolutely.
loans, you shouldn't have plan loans. That's my first opinion. And I know I have a couple clients on the line or watching this presentation too, probably smiling right now because I find plans that do not allow loans are happier in the long run, and that the whole concept of retirement planning is for retirement savings, not to have access to, obviously you could use it for hardship type of situation, but some people use it for just living their day-to-day life, and that's not the purpose of these loans to begin with. But the CARES Act obviously extended the rules, the typical rules. You can take a loan of 50% of your account balance, not to exceed $50,000. Under CARES Act, if the plan sponsor decides to add this amendment to their plan, the rule changed to 100% of the account balance to $100,000. Now, I caution a lot of people because if you now take a $100,000 loan out instead of a $50,000 loan, and you have to still repay it over 5 years, can that individual participant afford repaying it over 5 years? Or are they having a zero paycheck or a negative paycheck because of the size of the loan? So some of the issues I wanted to address to that. Anything that you needed to add to that section, Melissa?
Well, I am total agreement first for your first comment, which is don't have loans in your plan. I will tell you, clients with loans in their plan have more legal fees than clients that don't have loans in their plan. By adding in this extra $100,000 for the loans, and by the way, if the plan has a limit of one loan at a time, and they've taken it out for the $50,000, an employer is not required to amend the plan to add 2 loans, for example. So you could get, the $100,000 loan. There's no requirement to do that. So this additional loan feature, as well as the in-service $100,000 feature, could mean participants that have more than $200,000 or more in their account could take out $200,000 out of their plan. So it's a substantial amount just leaving the plan if under the CARES Act. There is a temporary deferment of the loan repayments if the plan sponsor wants to add this for COVID-eligible employees. Again, this is only for COVID-eligible participants, not any other participants. So it gets very complicated, and the tracking becomes more complicated for you as a plan sponsor and for the record keeper. Again, amendments generally are not required to 2022, except if you're changing your loan procedures. The participant could get a reamortization of the loans, and it could extend out more than the 5 years, depending on the circumstances. So this is something that Dave from Transamerica could pop in anytime he wants. I don't mind explaining how Transamerica, for example, is tracking this type of thing. Some record keepers said to their plan sponsors, we're not going to go to $100,000. Us as a plan record keeper are only going to $75,000 or 75% of the vested account balance. That's what they're having programmed into their record keeping systems. So again, I know I'm stating the obvious here. You as a plan sponsor must coordinate with your record keeper to understand what is really happening, who has responsibility for changing the plan procedures, amending the plan if necessary, and communicating clearly to plan participants what exactly is going on. So there's a lot of work here for CARES if you're going to add these features, or if you've already added these features.
Melissa, I couldn't comment better than that. I definitely said, before anybody just automatically says, yeah, let's just go ahead and add it, you got to put some thought behind what you're doing there, for sure. Our next question says required minimum distribution delayed for 2020. Just so everybody knows, under this CARES Act, anybody who needed the required minimum distribution for 2020 does not need to take it this year. So they can defer doing any minimum distribution for this year, for 2020. However, if you're one of those early birds that took the distribution earlier in the year prior to the CARES Act being enacted, which was March of this year. So if you did it in January and February, you can't take that money back. So you already took your distribution and that's going to be done. So I know some people took it back in January and said, oh, can I reverse that? Too late, can't reverse it. next slide, if we can. And just finishing up on some of the stuff, the last slide on COVID or CARES Act. Can employers change their contribution under qualified retirement plans? Just to, you know, we mentioned David Mitchell. Dave, why don't you just pick up on this real quick on the safe harbor pieces? I know you mentioned it earlier to me about it. So what are your thoughts? What do you know about the safe harbor pieces, and if somebody wants to change it?
Thanks, Pete. Can you hear me?
Yes.
So I'm Dave from Transamerica. I appreciate the time today from everybody. My background is in 25 years of helping employers design effective retirement plans to encourage the largest proportion of their employees to reach a well-funded retirement. And this is an excellent conversation. The theme that I take from some of this CARES Act discussion is simplicity is key. Adding complication to a retirement plan just because it's legislatively available could cause trickle-down effects that we don't see at the time, that we don't consider at the time that we make a rash decision to include these provisions in plans. So if we make the rules more complicated, it becomes exponentially more likely that plan sponsors, payroll providers, all the stakeholders can run afoul of those rules. And I think that gets back to Melissa's point about how legal fees can be higher in plans that offer loan features. And that's because of additional complexities. So I agree with Pete regarding the loans very quickly that it's probably not a great idea to include because it is the area of plan administration that is most frequently messed up. So when a new employer hires Transamerica for record keeping, that's the area where the data is usually all a mess, is in loan repayments. And so providing new rules around different types of loans adds a complexity for tracking those, which the big record keepers are certainly very capable of. But the key point is to make sure that the financial advisors, the plan sponsors, and the participants are fully engaged and aware of the new rules if they're choosing to exercise these new plan features. So I think this is an excellent conversation. So let me address the safe harbor question, because this is very good. This is very good legislation that allows flexibility for employers regarding their decision about safe harbor. So safe harbor is a very commonly used feature in retirement plans to assure that the highly compensated group, as defined by the government, is allowed to fully maximize their available benefits. So it's a great feature. And up until this very positive change about flexibility, safe harbor elections were an annual election that required an employer to make a decision before the beginning of the plan year and then make that decision in enough time that they can communicate to their service providers, like the record keepers and TPAs, to produce employee notices that need to go out 30 days before the start of the plan year. So there had to be a decision, an evaluation of costs, and implementation notices. And what's happened here is that we've got flexibility, because if you're qualifying for safe harbor through an employer non-elective contribution, not through matching, but non-elective contribution, that notice requirement no longer exists. So it's a great flexibility, because the employer now mid-year can convert their plan to safe harbor because they weren't required to hand out a notice before the year began. And it also eliminates the messing around that used to happen, where an employer, uncertain as to whether they wanted to be safe harbor, would distribute a maybe notice and then later reaffirm that they wanted to be safe harbor before the end of the year. So the specifics of the new rule are that you can amend your plan in the middle of the year to be a non-elective safe harbor. And in fact, if you do it, roughly speaking, in the first 11 months of your 12-month year, the cost is the 3% non-elective contribution that was always safe harbor. But the rule went even further, and it said, Well, you can do it after that too. You could wait until the last month if you want. And in fact, you can wait until the year's over. The cost is a little bit higher at 4% employer contribution, not 3%. So the cost impact. But besides the elimination of the maybe notice, the other huge benefit for this is that an employer who is not currently safe harbor and the year ends, and when the non-discrimination testing is calculated the following spring, and we realize, oh boy, the highly compensated group has contributed too much and refunds might be necessary, this is a possible remedy for a failed non-discrimination test. So it means that after the year's over, a plan has another way to remedy the failed non-discrimination test by simply retroactively saying, okay, we're going to be safe harbor. So, and that would be safe harbor through the non-elective contribution, not through the matching. So I expect that to be a brand new option for plans, because in the past we were stuck. The plan would end, plan year would end, failed non-discrimination testing, but yet we're into the next year. We can't be safe harbor. So we'd be diring that, okay, in the following year, we really need to get into the safe harbor. So it was something that a lot of employers wanted, but they never had the foresight to make a decision before the plan year. And it took usually 2 or 3 years before they could actually make that decision and become a safe harbor with the proper notices before the beginning of the plan year. So this is very good legislation, because it's going to allow people who want to contribute to a well-funded retirement are going to be able to do it, because more plans are going to be safe harbor, because there's now flexibility for employers to adopt those safe harbor provisions in the middle of the year or even after the year's over. So this is really fantastic.
Dave, thanks for that information. Obviously, you combine the COVID Act, the CARES Act, and the Secures Act there in the slide, which is okay to do. But yeah, but the important thing that I want people to take away with is that if you're safe harbor today and you're stressing about the future of your organization or the budgeting of your organization, and if you can afford to continue to do the safe harbor, check with your professional, check with your record keeper. There are ways to freeze or stop that safe harbor mid-year or this year should you have financial issues as a firm or whatever. So I don't want you to think that because you have a safe harbor and you already notified all your participants about it, that you don't have any recourse to stop that. They may be a little bit more difficult depending on how your document is created, but you do have the right to on that. Melissa, can you just touch real quick on the last slide? I want to move on. Can a reduction in force result in a partial plan termination? I think most people don't realize that if they have a significant reduction in employees or participants, that could trigger a partial termination of a plan.
Correct, Pete. And in fact, I have a client that's a pretty major corporation in the transportation field, and due to COVID, they're just not transporting folks like they used to, and it appears that they are laying off, obviously, well more than 20% of their workforce. And the IRS uses a bright line to generally determine if there has been a 20% reduction in force, that if there is a vesting schedule with the employer contributions, those individuals that are terminated due to the reduction in force would be 100% vested. So if your organization has, for example, a 6-year vesting schedule to obtain a full match or a full non-elective contribution on termination of employment, but many of those employees, as part of this reduction in force, are, say, 60% vested or 40% vested, they would become 100% vested. So if you're relying on your forfeitures to budget future contributions, you may want to have a different forecast on budgeting contributions, because there won't be forfeitures to use for future contributions if you have a more than 20% or more reduction in force. And a furlough is generally not a reduction in force immediately. But if you end up furloughing people and then at the end of the day they're actually terminated, that termination will cause the reduction of force. The DOL and IRS will be looking at the Forms 5500 for the year 2020, because in that 5500, it would show if there was a 20% or more reduction in force, and they will be auditing. They have an auditing project looking at if there is a 20% reduction in force to make sure those individuals were fully vested, if not fully vested. Your record keepers may be looking at this or may not be looking at this for you. So you want to make sure your record keeper is tracking your numbers so you're not surprised 2 years, 3 years down the road that you may have forgotten to fully vest participants if you did in fact have a reduction in force, even due to COVID. There has not been any kind of exception due to COVID.
Thanks, Melissa, for that update. It's important. I mean, we're not, you have to do whatever you do for your business line right now. If you have to lay off or furlough, you do what you need to do. Just understand there could be consequences to other things than just the personnel issue. So it could reflect to the retirement plan and the vesting and so on down the line. So once again, always check with your professionals, whoever they may be, and your resources to understand fully instead of being surprised. None of us want to be surprised. That going on, we're going to talk about we pretty much went through all the CARES Act and the effects of that. So going back to the Secures Act, standing for Every Community Up for Retirement Enhancement Act. That was established in December 20th, 2019. Now, here's the interesting thing about the Secures Act. I've been tracking this thing forever. Believe it or not, the first legislation of Secures Act was 13 years ago, was the first legislation on Secures Act. It took 13 years to have this become a law or an act. It reminds me of when I was a kid, Schoolhouse Rock on Saturday morning, how a bill becomes a law. Yeah, here's a good example one. A bill that became a law. It took 13 years. But it just goes to show you, if it had some good stuff that was in it, it eventually will become law. The surprising thing is my industry, our industry, the retirement plan industry, knew that this act existed and that this bill existed and that it was someday going to become law. But we've been waiting for 13 years. And then for 13 years, it changed variations of it so many times that you couldn't prepare for it because you didn't know what was going to be in or out of the rules. So because you can't prepare for it, you wait for it to become a law or an act. Well, no one expected this to become law on December 20th of 2019. It was at midnight type of thing. It got snuck in with the budget, and all of a sudden we woke up on December 20th and said, "Oh my God, we have the Secure Act now." And all of a sudden, the Secure Act also said it becomes effective immediately, or January 1 of 2020. Surprise! Even though we knew this thing was 13 years, but it surprised all of us, and none of us were ready for it for the most part. So we scrambled, and quite honestly, with everything that's gone on since March of this year with the coronavirus, the Secures Act seems like it's decades old already. It happened a long, long time ago. But we're just in the midst of implementing this thing. And there's some rules that went into effect January 1. There will be other ones that go into effect in 2021 and even more that go into effect 2022. So we're going to go through some of the bulk of this presentation today, and it affects the required minimum distributions, 401k. When you see 401k, we also say 403b and synonymous to it, penalty-free distributions and stuff like that. So we're going to go through that real quick with you overall. So again, going back to Melissa. Melissa, I'm going to let you to cover 401k, 403b plan coverage for long-term and part-time employees. This takes into effect, I believe, and I'll let you know, the effective date is there. You can cover that, but the rules and how this affects. And then, I can go. the modification afterward.
Sure, it actually goes into effect in 2024, but if an employer is going to be part of this rule, the plan sponsor, the employer, has to start tracking this rule in January 2021, which is not far from now, and your programmers need to start tracking this. This is a, I don't know, a rule that I don't know who lobbied for this.
Because I know we have some nonprofit organizations on the line. When we say 401k and we say 403b, I think most organizations know today as a nonprofit, you can have a 403b or a 401k, either or, and there's pros and cons to both. But I just wanted to highlight that and mention that because I don't want
but this rule is just for 401k plan sponsors.
Yeah. But I don't want that to mean that the nonprofit doesn't think that this may not apply. They may have a 401k plan.
Oh, absolutely. In fact, I would say half of my clients that are not-for-profits sponsor 401k plans versus 403b plans. So I wanted to just let everybody know about this strange new rule that, frankly, I don't know who lobbied for this thing because it's so complicated. But generally, the rule is, oh gosh, we just got a pop-up question here. I'm just answering whatever. Okay. So the rule is, if you have a 401k plan, and I'm not going to go into a lot of this because it's so complicated, the rule is generally you could exclude part-time employees if they never reach 1,000 hours in 12 months of service. Well, the new rule, that's the old rule, and that old rule still continues to, even after this new rule. So now you have to possibly track two rules for part-time employees. And but for tracking this, it may cost more just to let you know to track this than to just let part-time employees in the same as full-time employees in a 401k plan after you hear this. If a long-term part-time employee works 500 or more hours in 3 consecutive years, in 3 years, that individual then comes into the plan just for their own 401k deferrals, unless you amend the plan to allow them in for matching and profit sharing or non-elective, beginning in the year 2024. Are you able as an administrator to track 500 hours for part-time employees for 3 consecutive years to know they should come into your 401k plan? In addition, you still have the 1,000 hours and 12-month rule. So even though the effective date for this is until 2024, you have to start looking at this seriously now to implement the tracking in 2021. Again, this is something you want to talk to your service providers, your plan providers, your payroll providers, your record keeper, your TPA, your investment advisor, how to handle this and whether to just make things easier, which I like, versus making them harder. As you know, if you sponsor a 403b plan, employee contributions start immediately, except if your plan document excludes individuals that are hired that are believed to be working less than 20 hours per week. But once they have 1,000 hours in a year, they come in. So this long-term part-time rule only applies to K plans, not 403b plans. Maybe another reason they have a 403b plan.
Interesting how these things get enacted, but they don't work to administer these things, and administration can be a nightmare.
Yeah. Well, and so everybody got consumed by the CARES Act, but are forgetting, by the way, what are your record keepers doing about the Secure Act? Well, and this was a great modification to the required minimum distribution rules they've been moved from 70 and a half, which, you know, half years are always fun to implement in a challenge, to actually 72, not 72 and a half. So it's easier to understand. It's later. Participants can, or former participants can keep their money generally in your retirement plan to age 72. Now, the CARES Act, intertwined with this, has basically participants and plan sponsors alike can stop minimum distributions for the 2020 plan year, and they would start again in 2021. So this is a administrative challenge that your record keeper might have already handled for you operationally in the CARES Act. So the Secured Act, which came, just like Pete said, came upon us like even after 13 years immediately. Your record keepers have had to change their record keeping systems to deal with 72 and not 70 and a half, and then to deal with a stoppage in 2020. So it's a lot of work for these, you know, your record keepers, and they might have made a decision one way or the other how to handle this and how to handle this in your plan. So if you have individuals in that age range, you know, this is important. If nobody is in that age range right now in 2020, you probably don't have to worry about this. They also shorten the minimum distribution timelines to get distributions to 10 years rather than the lifetime of say a grandchild, for example, and the effective date, as I said, or Pete said, was basically immediately in January 1, 2020.
Melissa,
And in addition to that,
I just want to clarify on the age 72. If somebody turns 72 this year, for example, they have till April 1st of next year to take that first year required minimum distribution. So
correct.
Like someone turning 72 this year, well, actually, but the COVID Act, the CARES Act says you don't have to take the distribution anyway, so you don't really have to worry about it. But the rule says the year that you turn 72, you have until April 1st of that following year to take the distribution for the first one. And the 10 years rule it's a little bit more complicated. It's a way for the government to get tax dollars sooner than later. So.
Right. So since they moved everything from 70 and a half to 72, they have to make up for the taxes they were losing in that year and a half time frame. And so this 10-year rule is a way to balance moving to age 72.
Yeah. And I think the last bullet point there on the 401k 403 safe harbor guidance, Dave Mitchell did a pretty decent job in talking about that part of it also. We're just going to move on for time's sake, if we can, move on. IRA contributions under the Secure Act. Investors can now contribute to their traditional IRAs. So before, as an individual, once you reach 70 and a half, even if you were employed, you could obviously always continue to contribute to your 401k or 403b, but if you were employed and wanted to contribute to an IRA, even once you reach the age of 70 and a half, you could not. So the government reenacted, looked at it and said, hey, so what if you're 70 and a half, if you got earned income and you want to contribute to an IRA, why not? So they added that. And that's all I'm going to say about IRA contributions today. Roger, we haven't heard from you. So, you know, we saw that the government saying, hey, we're going to give you some tax relief on certain things. But what they take away in one hand, they give it in another hand, right? Or vice versa. What they give it in one hand, take away in the other hand.
Exactly. So what they've basically done, if you want to take simple math, is they've increased the potential fines by an order of 10. So in past years, late 5,500 was $25 a day per participant, up to a possible penalty of $15,000. Now it's $250 a day per participant up to $150,000. That is a significant increase. Now, there are mitigating circumstances, and our firm does act as a fiduciary. We serve as the plan administrators on our plan. So we deal with this with our ERISA attorneys. And there are a lot of times circumstances may come into play where you don't get the maximum penalty. There's also a penalty to file a registration statement for a vested terminated employee. It's $1 a day in the past per participant per day. That goes up to, I believe, now it goes up to $10 a day. So it could be a maximum penalty of $10,000. So everything that's been added is another complication that plan sponsors are going to have to deal with, working with their advisors, working with the record keepers, working with their TPAs to make sure that everybody is on the same page. Most plans do not have a bank account that they can write a check to the IRS or the Department of Labor for $150,000. So this is, go ahead.
And Roger, could I add to that? I'm seeing the DOL and IRS really go against plan sponsors, and I see it in the area of when you change record keepers and the prior record keeper doesn't file that 5,500 when you transfer to a new record keeper. And if the DOL does not get the penalty paid, they send it to a collection agency, and it is bad. You can't even negotiate. So I have seen these penalties just run up, and this was before the increase. I can't imagine what they're going to try to do now with the increase.
That is a problem now. Hopefully, the plan sponsors have taken into consideration the liability of being a plan sponsor and a fiduciary on the plan in some way, shape, or form, maybe with fiduciary liability insurance to cover some of their mistakes. But in general, most small plans don't, for a lot of various reasons, don't carry that fiduciary liability insurance. So it's personal liability. So theoretically, you're the plan sponsor, you're the fiduciary under the plan documents. They could come get they could come get your boat and take it away from you. Theoretically.
Yeah.
Yeah. That's all theoretically, but yeah, it's going to be interesting. This
My
puts a
word
lot
of advice to everybody, though, right, is try to get everything done on time or
Yes.
at the end of your extension. Whatever you can do not to wave a red flag in front of the Department of Labor or the IRS.
Yeah.
In your favor.
Yeah, if nothing else, depending on what record keeper you're using, a lot of them are maybe integrated with a TPA or a payroll company that's offering a 401k, and they'll send an electronic version of the 5,500. And we run across this all the time when we convert a plan. The employer hasn't sent in the 5,500 for 2 or 3 years because they thought that the copy they got electronically from either the TPA or from the payroll company or from the TPA that's internal at the record keeper, they had filed it for them. So we do see a lot of that, and it's a significant problem because if you're going back and not recreating, but actually completing 5,500s for a 3-year period, that in itself can get very expensive.
Yep. Well,
And one more point, Roger mentioned the ERISA rider fiduciary insurance. I will tell you that the fiduciary insurance companies have changed their questionnaires significantly in the past year. And one of the questions they are now asking is, who is your record keeper? They want to know the record keepers. They want to know everything because of these types of penalties.
Very good point. I've seen more of that too myself with the property casualty insurances. Moving on to a topic of open multiple employer plans under the Secure Act. Now, what's interesting here, we have Roger from TAG and we have Melissa from Littler, great professionals, and I value all their opinions. We have two different, and for transparency's sake, I will mention that we have different views to the what we call a MEP, multiple employer plan, or a PEP. But it's interesting, there's two different views here. Both are right, so there's different approaches of how you can get to things, and there's pros and cons to these type of programs. So again, if you're looking to do something like this, again, professional help is beneficial here, and go in with eyes wide open because there's pros and cons of stuff. Roger, you finished the last slide. Why don't I let you put your opinion here and your expertise on this slide, and then Melissa, I'd like you just to chime in on from an ERISA attorney some of the things that you want to be concerned about.
Yeah, so I'm sorry, the questionnaire popped up right in the middle of what you were saying.
We
So
purposely did that.
I couldn't read it while you were talking. So I just hit a button to get it out of the way. First of all, what Pete mentioned before, this idea of combining companies together in pooled plans without commonality has been going on forever. 13 years is a long time. And a lot of the press that I saw coming out of this and a lot of the releases by Congress in general made this sound like the end all of end all and a panacea for all small plans. So I want to make a statement here. Pooled plans are not for everybody. Then there are really three types. There's three types that were covered by the Secure Act. Closed MEPs, which are basically MEPs that have commonality and control, maybe an association of car dealerships form a closed MEP, and therefore is a pooled plan, and there are regulations around that. That has been in existence for quite a bit of time. What the legislation really was addressing was what many consider an archaic rule, or using a legislation back that was a legislation, not a legislation decision, a DOL decision tying MEWA regulations to retirement plans, which doesn't really make a lot of sense. So what used to be called open MEPs are now called PEPs, pooled employer programs. We actually ran an open MEP back in the day when there was no regulations on it, begging for guidance. We were able to get that turned around with the Department of Labor, and now run one of probably the largest pooled single employer program in the country. And it works well, but you have to understand that in doing that, you are confining yourself to some restrictions. You're sharing common menus, investment menus, for example. You're sharing a common record keeper. You're sharing a common TPA. You're sharing a common fiduciary, whether it's the 316 fiduciary, the 338 investment fiduciary, or in our case, we're also serving as the plan administrator under 402A. So there's not as much flexibility. And then you've got something coming out in 2022, which is basically called a group of plans. And that's a capital G, a lowercase o, and a P. At least that's the last version I've seen from the IRS. And what that is basically, here again, a collection of single employer plans. And the difference is that you can file 15500. Sounds great. Closed MEP sounds great. PEP sounds great. Group of plans sounds great. But I will throw out a little caveat on there. Somebody has to be responsible to get these files to the record keeper in a timely manner. So you're best served if you've got a program that ties in either a payroll integration program or a company like what we've done, and build our own payroll integration process where the feeds come to us and then we bundle them together and fire them up the record keeper. So there are some limitations, but the goals of this were basically to make plans more accessible to smaller companies. In the long run, bring down cost. In the long run, provide fiduciary sort of a coverage for the plan sponsors, so they're not having to be super experts anymore. They have fiduciaries doing that for them. Sort of like in World War II, if you were in an aircraft carrier, you had fighter coverage over the top of your aircraft carrier. That's how you stayed alive. So the fiduciary functions serve in that coverage, making sure things are done correctly. The one bad apple rule really applies to those closed MEPs, PEPs, same thing. Some of the challenges on this are, let's just talk about, Pete mentioned startup plans. All the advisors want assets, let's face it, we want assets. But in this Secure Act tied to this MEP versus PEP versus GOP versus pooled single plans, there are a couple of things that we can get that you have to be aware of. If you join a open MEP or / PEP that's been in existence more than 3 years, which isn't going to happen today because they don't exist, some of the tax credits that are available for starting the plan after that 3-year period, because it goes on the start of the plan, and these are plans. These are not group of single employer plans. They are a single plan. Those tax credits disappear. That doesn't apply under that group of plans, and it doesn't apply to a pooled single employer program. So the challenges are not that I'm doing this to make Pete feel better. Find an advisor that knows what the heck they're doing. That's number one. And has experience in this market. 2, find a TP. If you're working with a local TPA or you're working with another provider, find someone that has a history of 401k, of working in the 401k market in a MEP situation where you're having aggregated or pooled employers. I've heard one person describe running a multiple employer plan and running some of these pool plans is like a a rodeo clown trying to keep themselves alive and away from the bull. It can be very chaotic, because think about it, these administrators, the TPA function, fiduciary functions, you're not looking at one plan with individual plan designs. You're looking at multiple plans, certain restrictions that have multiple plan designs, multiple payroll cycles, and multiple issues. So it may sound like I'm trying to downplay the value of this. It's just make a logical decision if you're interested in these type programs after doing your very stringent due diligence with some professional help.
Well, Roger, if I can piggyback off of that a little bit, the concept here is, if you think at it, ideally, it's like, hey, why don't we as employers pull our assets together, almost kind of like a health insurance type of program, right? Let's pull our assets together, our plans together, and aggregate them so we can get better pricing, better this and that. And, in theory, it sounds really good. And I don't care if it's a startup plan or $100 million plan. If you can pull these all together and all of a sudden say, where do you have $1 billion in assets, or we have $10 billion in assets, and then come to a provider or go to an investment firm, a mutual fund company for pricing, you would think it would make more sense. And it would be better pricing all the way around. But then you have to understand, how do you administer all these things, and how do they work, and what are the side effects of these things? So again, good idea, good concept, just go in with your eyes wide open. With that being said, Melissa, briefly, why don't you come at it from an ERISA attorney standpoint?
Yeah.
And
I'll do this briefly. Yeah, agreed. Number one, you got to read the contracts of the service providers, because do they have the deep pockets to handle any kind of claims by participants, DOL and IRS? And are you sharing in any of these audit expenses, et cetera? Like, for example, with a MEP, you'll have you generally have over 100 participants, so you'll have an outside audit. Well, if you're a small employer on your own, and you have less than 100 eligible participants for your plan, you avoid an outside audit. So now all of a sudden you're paying part of the cost for an audit that you didn't have to pay in the first place. So there are many challenges to being in a MEP. One is big pocket. I have a client that entered into a MEP recently due to certain collective bargaining issues. They had to enter this MEP. Well, the MEP plan sponsor has only 2 employers, or maybe a few employers in this plan, and my client was going to be the big dog in this plan. And I frankly know, and they did it anyhow, that the sponsor of it didn't have enough insurance to cover the liability that's going to happen if there's any liability. So those are types of challenges. One more challenge, and I don't know how often this may affect this audience being tax-exempt employers, but I have had tax-exempt employers merge with other tax-exempt employers, and to unwind from a multiple employer plan is a significant challenge versus unwinding or merging or anything like that with a single employer plan. I've added to acquisitions legal fees and resource fees, frankly, from, like $50,000, just to throw that out, of how to handle when you're, removing yourself from a MEP. So that's a challenge.
Thanks, Melissa. But my last comment on this, it's kind of like going back to my babysitter analogy. As a parent, always go with your eyes, do your vetting and do your analysis on the stuff. They're all good and bad approaches to them. Another part of the Secures Act is this lifetime income provision. I am not going to take a long time on this, and actually we're going to move on for timing's sake, this slide and the next slide, and we're going to move on pretty quickly. But basically, the lifetime income provision is basically saying that under the Secure Act, plan sponsors, employers, along with the record keepers, will have to initiate an option within 401ks, specifically, I'm not sure about 403b, that shows a participant what their income might be from their from their retirement plan in the future. So what we've done as advisors and what we've done with the retirement plan business is that we've helped people accumulate money and done very well, I think, in helping people accumulate money. We haven't really had a system on how to take distributions once they've accumulated all this money, and a distribution that doesn't fluctuate in value, a lifetime income, kind of like the old pension plans that our grandparents had or our parents might have had. So how do we draw from that? So the Secures Act went through some of this and allowed some safe harbor provisions to the plan sponsor, protecting the plan sponsor that if they did go down the road of adding a lifetime income option within their 401k, there's no recourse by the participant to come back. And some of the issues come back into is basically these are guaranteed income returns that are paid to a participant. There's a lot of issues that can come up with. Should a 21-year-old or a 30-year-old be putting money into a guaranteed income type of an annuity product at their age, or should they be more in a growth-oriented investment option? So these acts allowed for some safe harbor provisions to protect those participants. And then some of the challenges of how do you do that lifetime income? So we're working through that. We're going to see some more information about that. We're waiting for the DOL and the IRS to come up with some final rules and regulations. You'll see that the effective 12 months after the Department of Labor gives some future guidance. It's coming. So in the future, you're going to see retirement plan statements showing what is the potential of the lifetime income on your assets. It's coming that you're going to be able, for lack of better terminology, to buy an annuity within your 401k that's going to guarantee you a monthly or annual income off of that. So, and provide protections and guidance on that. So some of the things that are coming, you know, I have mixed feelings about this right now. I'm not sure if it's obviously not for all participants, and how the solution is, because one of the things we pride ourselves on with these type of 401ks and 403bs is the portability of being able to move. If I change employers, and we know that the average American today changes, I don't know, 7, 8, 9 times in their career, in their lifetime, and they're able to move their retirement plans from one employer to the next, how do you portably move a fixed income type of situation where you have an annuity option? So these are some of the challenges that they're still working on. And again, if anybody had some additional questions or comments on that, we'll get some more clarity on that in the years to come. So unless if Melissa, Dave, or Roger have any comments, I'd like to just move on from there.
No comment.
Awesome. This may not apply so much for the nonprofit employers that are in our group because of the tax credit, but it does apply to any for-profit organizations that are looking to put in a retirement plan basis on that. Any of the panelists want to cover that briefly or quickly?
Sure, Pete, it's Dave. I'll address that. The tax credit portion of the legislation, I think, is very important to improve the previous legislation. There was a tax credit that had been in place before, but it was not a strong enough motivation to overcome the chief reason that small business owners say they don't offer a plan, which is expense, and then followed by administration. So the improvement here is to take the maximum tax benefit from $500 per year for each of the first 3 years to $5,000, a tenfold increase in the maximum tax credit for smaller businesses starting up a plan like less than 100. The reason this is an issue is that many studies cite that only half of US workers have access to a company-sponsored retirement plan, and that those who do have access to a company-sponsored retirement plan are 15 times more likely to use it than to save on their own in an IRA. And half of workers are saying that they are stressed about money. So this is a key initiative, is to get more of us who happen to work for smaller employers access to a workplace-sponsored retirement plan, because it's a key driver of being well prepared for retirement. So this was very good news to help businesses take advantage of it. And that 50% cap is not always the case, because it can be combined with another tax credit for starting up a plan. So in some instances, more than half of administrative costs are covered by the tax credit.
Thanks, Dave. You know, you brought up a point that I'll bring in that's associated to this. And that is, you know, I think when you mentioned about the payroll deduction and 401k contributions and stuff like that, I think about my own 401k contributions that I've been making since from this year, right? And when the market took its 25% drop, close to 30% drop this year, I had a payroll deduction made from my 401k, and it got deposited. And I also have an IRA and other investment accounts outside the 401k. And believe it or not, here I am, a financial advisor for 36 years. I should have probably transferred some money from my checking account into the investment marketplace, but did I? No, I didn't. My human fallacy kicked in and said, hey, maybe I shouldn't invest right now. There's too much volatility in the market. Let me just keep my money or dry gunpowder on the sidelines, and I'll wait. In the meantime, I looked at my 401k, and those deposits I made a month ago or even 2 months ago are up already from where they are because of where the market is. So, you know, sometimes I don't listen to myself when I talk to other folks. You know, stay the course, invest on a regular basis, and just continue to do it. So, and that's the nice thing about a 401k. I looked at my plan sponsors. Most of those employees that are still, they're still working and having a paycheck, they never stopped their 401k contribution. They didn't change their contribution. Actually, we've had a few that increased it. And I think the positive thing about that is inertia. People think it's too hard to go online and make a change. So let's just leave things alone. And I've done it before. So, and that all benefits us for doing that way. So with that, I'm just my little 2 cents about the market. And by the way, if you want to know what the stock market's doing or where it's going to end up on the end of this year on December 31st, you're welcome to call me on January 1st of next year, and I'll let you know what the market did this year.
Yeah.
And if we can move on, I'm not going to spend a lot of time on this. And I don't know if anybody that ever offered this or had the option to, but the Secure Act specifically mentioned that if your plan allowed for loans, it no longer allows you to take that loan and issue it out as a credit card, like a debit card type of thing, for you to access your loan via debit card. They prohibit that going forward for right reasons. First of all, you know, I'm not a big loan guy, but that being said, to have somebody have a debit card or credit card where they could tap their 401k loan, to me, made no sense. So they finally put a law to act that that's a prohibited transaction now. You can't do it anymore. So that being said, anybody want, Melissa? Did you want to touch anything? I don't think we need anything.
No, just if again, this is for not-for-profits today, but if you have multiple members of your not-for-profit in a control group, you can have consolidation of your Form 5500. I think that's a big change, and also a later adoption for brand new non-elective profit sharing or pension plans. But I don't think that impacts anybody here.
Dues, right? So
yeah, there's a lot to do's.
I think
to go.
Obviously, Melissa and I were talking about this yesterday, and she and I have been doing this for 30 plus odd years each. The evolution of retirement plans from 30 years ago is significantly different. The regulations from 30 years ago are significantly different. The penalties from 30 years ago are significantly different. You know, we used to say, employers would put 401k plans in because they wanted to add an added benefit to their benefit program and figured it was automatic type of thing. Yeah, we just add a 401k, it'll run itself. It's gotten very, very complicated. So to seek professional help, be it through your record keeper, through your third-party administrator, through ERISA attorneys or legal advice, through your investment advisor or plan consultants, so important today to have the expertise. As I tell a lot of people, you hire me to take care of the things that you don't even know that you need to take care of, because the legality and the issues of all of this. So your to-do things is don't do this alone. Don't think you can get what they call bundled approach or turnkey approach of any type of retirement plan and just assume everything's going to run by itself. There's a lot of pieces that need to be worked at, and having the expertise behind the scenes, specifically an unbiased and objective individual, is very important for you to navigate through these marketplaces and record keeping and third-party administration. Because again, using that analogy of a babysitter, ultimately, if the DOL comes knocking, if the IRS comes knocking at your door, most of these record keepers or whatever are going to say, not our responsibility. We were hired by the plan sponsor. It's the plan sponsor's responsibility. So, it all constantly, you can never eliminate your fiduciary obligation. You can reduce it, but you can never eliminate it overall. Anybody else have any comments on that? Awesome. There were a couple questions, and thank you for everybody for attending this thing, but there were 2 questions that came out of this presentation. And Melissa, these are for you on the discussion of the long-term versus part-time employees. So who is considered a long-term employee and who's considered a part-time employee?
Well, it's really a long-term part-time employee. Anybody who has more than 500 hours in three consecutive years would be considered eligible for a 401k plan, even though they never had 1,000 hours in 1 year. So it gets a little complicated. The IRS has set forth their views, and it's in a quality assurance bulletin. And frankly, I think they would lose if it went all the way to the Supreme Court, but not one of my clients wants to actually take this to the Supreme Court. A part-time, seasonal, or temporary employee who works 1,000 or more hours in a 12-month period is now deemed to be almost a full-time employee for purposes of participating in a 401k plan, a matching plan, and a non-elective plan. So there's now two rules to bring in folks that you thought were temporary or part-time or project or something like that into a plan based on service time that you didn't have before. You only had the one rule, the 1,000 hours in a 12-month period of time for 401k contributions. I hope that helps, but it is very complicated and complex, and some record keepers might not even permit the adoption of any of these rules because it might be too complicated for their systems, and part-time, project, temporary, seasonal may have to come into your 401, if I'm talking 401k plan, in the same eligibility of who you would deem as full-time. And we're not looking at the same full-time, part-time as you look at for welfare plans. That's a totally different eligibility class and testing class. So a lot of my clients get mixed up and put on their website, on their career pages, for example, who is a part-time or full-time, and put in the handbook who is part-time and full-time and quote eligible for benefits. And it gets mixed up between the 403B plan, the 401k plan, and the health and welfare plan. So it's something that your whole benefits team needs to discuss and needs to look at all the communications, handbooks, plan documents, your website, and then your payroll provider and record keepers, what they can do, and your plan documents. So it gets very complicated. It's not an easy answer.
Thank you, Melissa. Appreciate that.
What's the second question?
Our contact information, by all means. If anybody has questions afterwards, please don't hesitate to reach each and any of us should you need to. Also, if you have any questions, now's the time to ask it. We'll take a minute or two to answer the Q&A. If you have any questions, go to the Q&A section and put them in now. Before I go to the next slide, just for legal reasons and go through it, yes, and I say this because there's probably somebody thinking this right now. Yes, my last name is Ponzio. I always joke about it because it used to be Ponzi, and as those of you who understand what that means, but Uncle Bernie had me add an O to my name. So that's my little laughter for today. That's as funny as I get. You know, they do say in the retirement plan business, especially people like myself with that I consider myself a ERISA geek, there's one group of people that make me look exciting, and that's morticians. So with that, I'll just give you the disclaimer on the next page so you know that we did some legal advice on the next slide, but also should you have any questions right now, please just mention them. We'll type them in.
So Pete, this is Sherry. How you doing?
Great, how about yourself?
Good. So just a couple of things. If you, I have one specific question with regard to the consolidation, the 5,500, you know, where you have a controlled group. So we actually do have some participants on the webinar. that could have that situation. So can you or Melissa maybe go through just quickly what the process is to get those consolidated? Is there some type of an election process, or, you know, what's the protocol?
That's a great question, Sherry, and I always refer to ERISA attorney expertise, because that whole control group and stuff, the definition of all that can get very complicated. And I've been through some circumstances where, you know, we've had a group of people in the room and had different versions of that same answer. Melissa, I gotta defer to you on this, on your expertise on control.
And I'm going to ask Roger if he could chime in, because he's a plan administrator, a 316 plan administrator. So it will be up to whether or not your plan administrator could handle filing the consolidated 5500s. And a lot of it, I think, will be due to, number one, whether or not you have to be on the same platform. So that'll, you know, if you're part of the same control group, you have to have the same investment, same platform in order to have a combined 5500. If you're on separate platforms, so say you're with Transamerica and with you know, I'll just throw out Fidelity, that will not work. And Sherry, I don't know if any of the participants on the phone are all with the same platform provider.
Yeah, I don't know the answer to that. But I think that's what you said is key. So if they are all participating in the same platform, now they have the opportunity to file one consolidated 5500, which you would think would actually reduce costs overall.
That's exactly what it's supposed to do. You know, this is going to be new, so we'll find out. And I haven't seen one yet. I think I'm trying to think of the year it goes into effect. It might be 2022.
Right. Okay. And then I had one other question, and this is, I know we only have a couple minutes left, but if you had, and this can go to you, Pete, or Melissa, or whomever, what would be maybe two top best practice recommendations that you can leave the group with for the day, you know, in terms of managing their plans and making sure that they get their, you know, that they are understanding all of the opportunities, all of the requirements, and making sure that they're hitting all their compliance requirements?
I could start, and Pete could interject. This is number one that I provide to all my clients is the DOL and IRS both have plan sponsor subscriptions to their websites that explain what plan fiduciaries, a plan sponsor, should be doing to make sure they are fulfilling their fiduciary duties as well as their compliance duties. It's a free source. There's excellent webinars, seminars, etc. And if any of my plan sponsors are audited by either the IRS or DOL, being a subscriber to either of those, both of those websites, really helps an audit go smoothly. And the second thing I would offer is having a self-audit procedure where and they are both available on those websites where you as a plan sponsor self-audit your plan, and especially if you're not large enough to be audited by a financial accountant, that self-audit would cover both the legal, financial, and DOL, IRS, and also plan participant issues. If you do that each year, it'll make sure you pick up everything that you need to do to be in compliance with your plan, and also have periodic investment committee meetings. And this is where Pete is very important, where it is documented. everything that you talk about is attached to those minutes. Make sure you're following up on what those minutes say. If you don't follow up and you fail to follow what those delegations of duties are, you could have a very expensive correction. So those are 3 tips to leave along the way, because we're out of time. But Pete or Roger or David, I'm sure you have further tips that you could add.
I would just follow up with, you mentioned it. You have to have at least one annual meeting, and it has to be documented. You can't just have it in the calendar thing that, oh, we had a meeting. You got to document that, because if it's not documented, the IRS and the Department of Labor are going to say it never existed. So document is so important to do so. And I'm going to self-prophesize here for myself, for our for independent advisory services. We really are a quarterback service where, we pull the Melissas in, we pull the Davids in, we pull the Rogers in at different firms as an unbiased and objective person. There are, I've heard many times from plan sponsors that they're utilizing a fully bundled approach by XYZ plan provider, and they do it all for us, and they provide us reports on a regular basis, and they do all that stuff. And my comment's always been about that is that's great. And I'm not saying that those firms do anything wrong, but if the name of the firm is ABC Company and they're offering ABC investment mutual funds within their program, and they're reviewing their own investment selections, I'm not saying that they're not giving you good advice and solution, but just does it pass the smell test? You have ABC Company reviewing and analyzing ABC funds. It's like people ask me, Pete, can we offer managed accounts within the 401k? Can you put together a conservative, moderate, and aggressive portfolio for our participants? And I go, yeah, I could do that. And I do that on the outside of 401k business. But in the 401k, if my models underperform, am I going to fire myself when I'm underperforming? So I want to be completely objective and unbiased, and I bring in other providers to do that.
We call that conflict of
all of the things are going to be completely unbiased.
managing conflicts and maintaining independence.
Absolutely. Yes, exactly.
Great. So
Yeah, and this is, go ahead.
Go ahead real quick.
Yeah, I was just saying again, as I brought up about the fiduciary insurance, really read those policies, understand what they protect you and don't protect you, and also, again, read the service agreements. I was in-house counsel to one of the major service providers. We put in the service agreement that our liability is limited to what you paid us the last 3 years. So if you only paid us $3,000, but we screwed up and it was like $100,000 blunder, we only owe you $3,000. So really read those service agreements, and you may or may not have negotiating power. That's the key.
Great. So we're actually over on time, and I apologize for running a few minutes over, but I wanted to just thank all the presenters today and all the attendees for attending. And as I indicated before, look out for an email that's going to have the presentation materials, a link to the recording, as well as the evaluation form, which would be required to be returned back to us in order to issue CPE credits. So that concludes today's webinar, and thank you and have a good day.
Thank you.